Thank you all for joining. We'll be starting in about 2 minutes. Okay, everyone, thank you so much for joining Kaiko Research's monthly webinar. We have this once a month. It's our analyst call, and you are joined by the entire Kaiko Research team here today. So we have a special edition. We normally focus on the biggest market trends, but today we want to focus specifically on Binance and Coinbase and what comes next. We have a bunch of data and charts presented by all four of us, and then we have a special bonus analysis at the end looking at some of the events of last week. So, as I mentioned, we are going to focus on 4 topics today. So I'll start by talking a bit about market share, the winners and losers. There's been a bunch of interesting trends in the market data. Connor is going to focus on liquidity and market making activity. Desi is going to focus on some trends, specifically asking the question, what comes next? And then Riyadh is going to focus on the CRV tether analysis. While this isn't necessarily related to Binance and Coinbase, it was a huge market event that happened last week. And of course, crypto being crypto, we really felt that we should cover it. But before we get going, a bit about Kaiko. In case you're unfamiliar, we are a crypto data provider. We've been around since 2014, and today we have 4 business services. Our first is our market data. This is tick level and aggregated data sourced from more than 100 centralized and decentralized exchanges. Our second business is our rates and indices. These are regulatory compliant. Our third is our quantitative analytics. This is for pricing and assessing risk. And then finally, this is our research. This is the entire team here today. And what we do is analyze all cryptocurrency markets using Kaiko's data products. So in case you have not yet checked us out, we have a new research website, research.kaiko.com. We'll send the link in the chat. But essentially, it's a centralized database now of all of our research, our previous analyst calls, and our reports. You can browse anything and also search. Speaking of our research products, if you have not already, I sent the link to subscribe to our newsletters. We have 2 sent on Monday and Thursday. We have a quarterly report, a weekly chart book, and then this analyst call, which we call the current. So first, how does Kaiko's research analyst actually analyze markets? We have comprehensive data services covering the entire centralized to decentralized spectrum. This is everything from CFI data, looking at order books, spreads, slippage, and trades on exchanges like Binance and Coinbase and Bitstamp, and also on the decentralized side, where we look at individual protocols such as Uniswap and Curve, and the lending protocol Aave. So this is unique DeFi data combined with unique CeFi data that enables the Kaiko research team to do all of the analysis that you'll see in this call today. If you have any questions, you can always ask during the call, and we'll have a chance to answer at the end. So the first topic we're going to focus on is market share and the impact of the SEC lawsuit last week. But first, let's talk a bit about what happened. The SEC perhaps had its biggest week ever when it comes to crypto. Last week, they charged 3 cryptocurrency exchanges, Binance US, Binance Global, and Coinbase. Binance is the largest exchange in the world, and Coinbase is the second largest exchange in the world. So this is a very, very consequential series of lawsuits. Let's dive a bit into what each one says per exchange. All 3 were hit with the same claims that they're operating an unregistered broker-dealer that offers securities. They essentially allege that a bunch of cryptocurrencies listed by these exchanges are unregistered securities. And it hit some of the most popular cryptocurrencies, such as Solana's Sol token, you have Cardano's ADA, you have Polygon's Matic. There were dozens and dozens of tokens listed, which essentially throws every cryptocurrency into question that is offered as a crypto service in the United States. But when looking at the specific claims per exchange, that's where things start to differ. On Binance US, you actually got some charges of market manipulation and wash trading. These are quite serious, and the SEC also alleges that there was no trading surveillance at all on Binance US. Not only that, Binance Global essentially solicited US traders despite not being allowed to have US traders, which were supposed to go to Binance US. Yet Binance ultimately seems to have controlled Binance US despite being separate entities. This is what the lawsuit alleges today. And then finally, with Coinbase, the lawsuit specifically says what's interesting is they group staking into the exchange offering, and then they also target tokens that are only offered through Coinbase Wallet, which is not even the exchange. Wallet often, you essentially are buying tokens through a decentralized protocol. So it's the first time that a DEX has sort of been half targeted by what we're seeing in the SEC lawsuits. So let's dive into the data. I think the most important chart that we want to understand here is the global market share of trade volume. In this chart, we have charted weekly volume since the start of 2023 when the crackdown began versus 21 other of the most liquid cryptocurrency exchanges. We have Binance US in orange, Coinbase in light blue, and then Binance Global in the dark blue. And of course, Binance Global, by and large, has the vast majority of volume, even though it's just one exchange relative to all other exchanges. But its market share has actually fallen quite a lot since the start of the year. It started at 64%, and today it's just 56%. Coinbase has also seen a slight drop from 8% to 6.5%, but Binance US, by and large, has been the most impacted, which we're going to see when looking at the volume share of US exchanges. So here we're narrowing in on specifically exchanges that are available to Americans. This doesn't necessarily mean the exchanges based in the US, but some more regulated entities offer US trading services. So what we're seeing here is sort of the collapse of Binance US. Binance US market share actually peaked in April of this year at more than 20%, and today it is just 1.5%. This is a massive, massive drop-off in market activity solely linked to the SEC lawsuits. And so the question we have is, can Binance US survive in a post-SEC lawsuit world? I think the jury is still out on that, but looking at the data, it seems very unlikely. Coinbase has also seen a pretty interesting drop in market share from 56% to just 50.5%. Even though Coinbase still is the largest US exchange, now that it is the target of a lawsuit, it also is threatened under this. In others exchanges, we're actually seeing a rise in dominance of LMAX, Bitstamp, and Kraken. So let's dive into a bit Binance US. Binance US by far had the most serious allegations included in the lawsuits. There were allegations of wash trading and market manipulation by a trading firm under the same entity as the Binance entity. So there, essentially what we wanted to look at is the volume share of cryptocurrencies on Binance US. We've divided the data between altcoin trades, Bitcoin trades, and ETH. And so one thing to know about crypto trading activity is that the vast majority of trade volume on US exchanges typically happens just for Bitcoin and ETH. These are by far the two most popular cryptocurrencies. So the fact that we're seeing a huge spike in altcoin trade volume from the period of 2021 to 2022, this raises a slight red flag just because we know that investor preferences typically are for Bitcoin and ETH. And so when we're actually reading the SEC lawsuit, it alleges market manipulation practices during the same time interval, specifically for altcoin markets. And so we can actually see this in the data, which is so interesting. And then right when essentially the allegations stop, we saw a big drop in trade volume, but we see an increase in Bitcoin and ETH volume, specifically because Binance US got rid of trading fees on the US exchange. Most US exchanges do not touch trading fees. Trading fees are the core business model. And also when you have zero fees, it makes it a lot easier to do wash trading because there's no fees. So these are instant red flags that we're seeing with Binance US. But the question we have now is, what is the future of altcoin markets in US exchanges? The SEC listed dozens of cryptocurrencies that they're essentially alleging are unlicensed securities. And so my colleague Riyadh, he did an awesome deep dive analyzing spot instruments on US exchanges to sort of understand the SEC's logic for selecting the exchanges they're targeting. And what he found is that Bitrex, which was actually charged a few months ago by the SEC and has since filed for bankruptcy, had by far the largest number of traded spot instruments out of all other US exchanges. It had more listed than Coinbase, more than Binance US, and it was also charged first, which is a coincidence or not. Coinbase, which has the second highest number of active traded spot instruments, was also second to be charged. And then we also have Binance US. So this just shows that it seems like the SEC could have been targeting exchanges that had a very wide offering. So the question now is, how are investors reacting? Here we break down the total trade volume on US exchanges divided between just Bitcoin and then all other altcoins. We can see here that since the start of 2023, the total quantity of Bitcoin traded has increased from 29% to nearly 45%. This is a huge increase, which suggests that a lot of traders are rotating funds out of altcoins and into Bitcoin, especially considering now dozens of altcoins are listed in the SEC lawsuit. If I'm an institutional investor, this might make me very nervous and I might be wary to hold altcoins. And then the last chart I have to show you today is zooming out market share data. It sort of obfuscates the global crypto trade volumes. So here I want to look at the raw quantity of trades on all crypto exchanges. And we can see here that since the start of the year, it's been a pretty tough year for trading activity, especially once you saw a wave of SEC lawsuits. Overall, volumes are way lower on both US exchanges and global exchanges. So this is just to show you that the crackdown in the United States reaches beyond just the US markets. It impacts global cryptocurrency trading activity. So now I'm going to pass it on to Connor, who's going to walk us through liquidity.
Yeah, thanks, Clara. Anyone that's been dialing into our webinars this year so far knows kind of how much we talk about market depth and liquidity, and more specifically, the deterioration of that liquidity so far this year. And it was particularly strong in Q1. We talked at the time, so about end of March, about liquidity hitting 10-month lows as measured by market depth. And market depth, as a reminder, is essentially a measure of liquidity and how many orders are placed on an order book within a certain percentage of the price. So we usually take 1% market depth, and charted here is Bitcoin 1% market depth across over 30 exchanges. And what we can see here, as I said, is that Q1, there was a real decrease in liquidity from about 14,000 Bitcoin to 8,000 Bitcoin on order books. That was amid the kind of banking crisis at the end of March, USDC depegging, and the start of, I guess, the regulatory enforcement by the SEC. And we really saw market makers kind of fleeing exchanges en masse. But since then, so Q2 has been somewhat encouraging from a liquidity standpoint, even though you wouldn't think so. We saw, liquidity start around 8,000 Bitcoin at the start of April, and that's up to about just over 9,000 now. And it's been ebbing and flowing, but it's been kind of gradually upticking as we've gone through the quarter, which is encouraging. The last couple of weeks now, I've seen a slight decrease in liquidity with everything going on. But all in all, while it's still kind of a low overall number, liquidity is ticking upwards, which is slightly encouraging. In the next chart then, I've charted the comparison between the US and non-US exchanges from a market depth standpoint. So this takes the percentage difference since January 1st. And again, as we can see, and as we reported on at the time, at the end of March, around that kind of US banking crisis, we saw US exchange market depth react more severely than non-US exchange market depth. And the thinking there was obviously that this was an issue that impacted US exchanges more and US market makers more, as kind of USD payment rails were shut down with Signet and the Send network. But again, rather encouragingly, US exchange market depth has picked up and been probably more resilient over Q2 than non-US exchange market depth. Again, that's kind of contrary to what you might think, and it was something really interesting that we found. So US exchange market depth then year to date is down about 15% compared to non-US exchanges are down about 20%. And in the next chart, I kind of look into the reasons why that might be and break it down per actual exchange. So what's really interesting about this is that initially it's Kraken jumped straight out to me. Kraken were one of the only exchanges out of 30 or 40 that I had a look at that actually had an improvement in market depth this year. So Kraken's essentially kind of flying the flag for US crypto liquidity right now, which is encouraging for the market in general. They haven't had any kind of, I guess, regulatory enforcement to do with their spot, like order book or anything, or spot markets. this year, whereas all its big competitors like Binance US, Coinbase have, and they're facing kind of regulatory issues of their own. And we can see there that Binance and Coinbase are kind of serving as a general proxy for the market, down about 25% in liquidity. But then on the flip side of obviously Kraken leading US liquidity, you have the exchanges that have been in the headlines from a US point of view. And they've been the ones where liquidity has really taken a massive hit. So firstly, Binance US, you can see liquidity just falling off a cliff nearly in the last couple of weeks, fell about 25% just even in the last week. And then year to date, it's down about 75%, which is a huge number for one of the kind of leading US exchanges. And then you have Bitrex, who were facing a kind of SEC lawsuit and declared bankruptcy as a result. They are down about 75%, 80% in liquidity as that kind of plays out. And then we also have OKCoin, which is maybe a lesser known US exchange. It's the US arm of OKEx. And they, around the time in March of the US banking collapse and USD payment rails getting shut down, they shut down access to kind of USD deposit and withdrawals. And that was only supposed to be a temporary move around the time of March. And that still hasn't come. They still haven't reinstated those USD rails to the best of my knowledge. And we've seen kind of market makers react as a result to just not coming back to the exchange. And the liquidity for market depth is down over 90% on OKCoin. So they're seriously struggling. So yeah, this is kind of a tale of different exchanges in the US reacting differently, like Kraken obviously improving in market depth, whereas the exchanges in the headlines have really suffered. And then Binance and Coinbase sit somewhere in the middle of that. And then the next slide then, I just take a look at the spreads then. So spreads, obviously another measure of liquidity, the bid-ask spread. And I kind of apply a statistical analysis here of the interquartile range, which is the middle 50%. That's the kind of shaded gray box there, middle 50% of outcomes. And the outcomes here are obviously the spread data points. And we can see then the Kraken again kind of flying the flag for US liquidity. Kraken have the lowest interquartile ranges, the tightest spread, the tightest kind of distribution of spreads, and the least amount of outliers. Coinbase come in second there for the USD spreads. Interestingly, with Coinbase, a few of their widest kind of ranges of spreads were actually for the Bitcoin USD pair, which would be contrary to the kind of the norm that we see with Bitcoin leading the way in terms of liquidity. Then you have Bitstamp, and then obviously Binance US as well. This was kind of just before the lawsuit was playing out, these data points, but it still had the worst liquidity for both kind of USD, Bitcoin, and Ethereum pairs, with the widest interquartile range, the widest amount of outliers. And yeah, just liquidity kind of suffering on Binance US even before these lawsuits were playing out. And as we saw in the charts before, it's really been hammered in the last few days. So yeah, that's it from a liquidity standpoint. And I can pass you over to Desi now, who will talk about what goes next.
Thanks, Connor. So I'll focus on the trends we start to see in terms of exchange offerings and fiat trade volumes. And the first chart I wanted to show is the number of delisted spot instruments. This data is available on our website. It essentially covers all spot instruments and centralized exchanges. Clara mentioned already that the number of listings is actually going down for some platforms. In terms of the listings, we also see quite a bit of increase. There are actually two things to see. The first is that in June we have had the highest number of listings since 2015, at least. It's even higher than what we had in November, when the two exchanges collapsed and a lot of instruments stopped trading. And the second important thing is that the number of the listings has actually been rising quite consistently over the past 3 years, actually. In 2021, the average number of the listings per month was around 120 instruments. This number doubled in 2022, and then in 2023, the trend clearly accelerated. So where are these delistings taking place? This is the next chart. We can move to the next chart. Yeah. So this essentially shows the listings in 2023, the breakdown by exchange. And what we see is that two US-based platforms, Binance US and Bittrex, accounted for around 18% of all the listings. This is pretty normal because, as we know, both exchanges were charged by the SEC. Bittrex filed for Chapter 11 in May, so a lot of instruments have been delisted. Other offshore exchanges, HIT BTC accounted for 18%, Huobi for 9%, and Binance, the largest exchange, accounted for 6% in the listings. An interesting thing is that the overall share of US platforms has risen quite a lot in 2023. It is around 22% currently, and the year is not over yet. And last year it was around 8%, so quite a bit of increase. I looked at the breakdown of the listing by instrument. So what you essentially see is that in terms of the listings, the breakdown between instruments is quite balanced between fiat-denominated instruments, Bitcoin-denominated instruments, and stablecoin instruments, which essentially means that not only the regulatory environment is impacting the listing, but also other factors such as liquidity. The Bitcoin instruments are not that liquid. And then when digging a bit into the fiat instruments in particular, we see that the trend has actually broken in 2023. The share of USD instruments has declined in 2023 to 50%. And we have much more Euro, GBP, AUD, and even Japanese yen quoted instruments being delisted. So how has this impacted trade volume? And this is the next chart. So looking at trade volumes by quote asset, we essentially see that stablecoin quoted instruments have held better than fiat instruments. The share of stablecoin volumes has actually increased quite a bit since last year, from 60% to 75%. And at the same time, fiat volumes are declining. And then the next chart is actually looking at fiat volumes in particular and which
Desi, sorry, we're having some connection issues with your feed. I think yeah, sorry guys, we have some Wi-Fi issues at the Kaiko office, but I'm gonna just do the last like two charts. Thank you so much, Desi. So sorry about the Wi-Fi issues. We're gonna get those fixed for next time. So yes, the stablecoin versus fiat market share on centralized exchanges. You can see the chart here. It's been a pretty big increase since the start of the year, increasing from 60% to 75%. This just comes right as fiat markets are essentially targeted by endless SEC lawsuits. We have Coinbase, we have Bittrex, we have everything. And so this trend very matches what is going on and directly linked to sort of the regulatory crackdown that we have in the United States. But when you're actually diving into euro versus dollar, fiat currencies are still, of course, extremely important in crypto markets. They're the ultimate on-ramp into markets. And we have euro versus dollar here, looking at the ratio of volume across all centralized exchanges. It's not just US-based ones. Some global exchanges also offer euro trading. So here we see that starting since the start of the year, we actually have the ratio of euro has increased from 10% to 20%. This has doubled relative to the dollar. So this is an interesting trend, which suggests that there are actually opportunities away from the dollar, away from a dollar-denominated crypto ecosystem. Even though it still is relatively small, there's a pretty bright future for the euro ahead if the crackdown continues in US cryptocurrency markets. And then finally, the crackdown has sort of impacted a bunch of platforms, specifically the payment channels. We have Binance that has been sort of the most hit. They actually lost their GBP banking access back in May, and we can see a big drop in crypto market activity, specifically GBP denominated crypto volume. of which Binance had the vast majority market share already. They also lost their AUD access. This is the Australian dollar. And so this shows that Binance was really the primary venue for all fiat denominated cryptocurrency transactions that were not the dollar, because Binance Global ultimately does not have dollar access. It has Euro, AUD, and then some other fiat currencies, including formerly GBP. So now we're going to pass it on to Riyadh. Again, sorry about the Wi-Fi issues. We'll fix that for next time.
Yeah, thanks, Clara. Hopefully I'm coming through all right. No tech issues. So yeah, the big news last week was that Tether depegged to 0.997 relative to the dollar. That doesn't sound like a lot, but when considering its volume, this was definitely consequential. And this was apparently related to some documents that were eventually published by Bloomberg and CoinDesk related to Tether's backing. Those came out on Friday, I believe. But if we look at this chart, we can get a little bit of a sense of like the lead up to everything. So this shows the cumulative volume delta, which basically just indicates, buying and selling of Tether. So if it's negative, that means there was net selling of Tether. Positive indicates buying. So I think there's a few interesting takeaways here. First is that the Binance USDT USDC pair was largely responsible for, or had by far the highest delta, nearly 300 million net selling. And what's interesting here is that about 60 million of that came in 5 hours on Monday. So this was a full 3 days before the documents were released, before the Tether depegged. I think the sort of other interesting takeaways here are just how important DEXs are. You can see that Uniswap V3, the Tether USDC pair, that actually includes all the pools, had a net a delta of like negative 150 million, so pretty substantial sell pressure there. And then the two curve pairs in the three pool combined for about 150 million. So taken all together, those two DEXs accounted for actually more selling than Binance. So again, DEXs are just really important. It's sort of impossible to understand market events at this point without a full understanding of DEXs and decentralized activity. And if we go to the next slide, we can sort of see another example of that. Oh yeah, can we show the? Yeah, thank you. So this shows the bid side liquidity for stablecoin to stablecoin pairs. Provides a little more context. So this is at the 0.1% level, which is critical for stablecoins because their pegs have to be much tighter. And so at this level, actually, sort of surprisingly, even before the depeg, USDC was a good bit more liquid than Tether, by this metric, which is a good sign for USDC, particularly when it's been losing a significant portion of its market cap. But encouraging signs on the centralized liquidity front. And I think it's important to note that Tether has a 0.1% redemption fee and a minimum $100,000 redemption. So in a lot of instances, it actually makes sense for institutions, large holders, to sell their Tether on the open market rather than redeeming it. If you can sell it for less than that 0.1% fee, then it's actually better. And with liquidity suffering, I think this could probably lead to more normalized sort of depegging events. I guess it depends what your definition of depegging is, but this is sort of an ongoing issue. And I wouldn't be totally shocked to see Tether, maybe reduce that fee a little bit, just with the understanding that like you want free flowing redemptions just to keep that peg stability. And so now we're going to sort of shift gears to another story that's a little bit more niche, but was sort of overshadowed last week by this Tether story. So here you can see all the transactions from the founder of Curve's wallet. So as expected, most of his like compensation is in Curve tokens, which sort of vest like on a linear basis mostly. And you can see that he's sort of built up this huge position on Aave. You can see that the plus signs indicate deposits, specifically orange plus signs are deposits of Curve tokens. And then you can see like the USD value. So you can see that he's sort of deposited them at times of stress when Curve's price was sinking. You can see November 2022, March around the USDC depegging, and then recently with just this sort of sell-off. And he's been depositing Curve tokens and borrowing stable coins. So he's built up about 180 million worth of Curve deposits and about 60 million worth of stablecoin borrows. If we go to the next slide, you can actually see this sort of aggregated. Thank you. And this just gives you a sense of like the scale of these positions, right? Like he's depositing over 200 million worth of Curve tokens in a month. I mean, it's pretty huge. And the concern here is that he might not have an intention of actually repaying this loan, of ever sort of winding down this loan. That essentially it's like a sort of soft liquidation, right? So there's nowhere near enough Curve liquidity for him to sell Curve tokens and get Tether or fiat. So instead he's depositing into Aave, taking out stable coins, not selling per se, but sort of getting liquidity and possibly even better execution than he would had he been systematically selling like a huge amount of Curve tokens. That's all speculation. I think the fact that he has been depositing more Curve, specifically when Curve's price has gone down, does indicate that he is like cognizant of the loan's health. Like he's not just gonna let it blow up and get liquidated. I think it does present a pretty significant risk, just because Curve liquidity, as we can see on the next slide, is poor. It's about 80% of it is traded on centralized exchanges, but you can see like the 2% bid depth is like just over $1 million. It's a drop in the bucket, really. And so, really the concern is if this loan does go into the liquidation zone, basically if Curve's price drops enough where it is able to be liquidated, that there's not enough Curve liquidity for liquidators to be able to sort of process the liquidations in an efficient manner, and that Aave would be saddled with like a huge amount of bad debt. During the Aave attacks, I think there was a couple $1 million worth of bad debt. I think in this instance, it would be a good bit higher. And in that instance, Aave has this thing called the safety module, which is composed of Aave tokens and Aave LP tokens. I personally think that is not a good system at all. They would have to sell Aave tokens to sort of cover this bad debt, which you can imagine the tokens would already take a hit because the protocol has been saddled with this bad debt. Then they're selling a bunch more to cover the bad debt. It doesn't bode well for the token, for the protocol. There's been sort of discussions to fix that, but they're still ongoing. And then there's sort of ongoing discussions about what do we do with this position specifically? What do we do with Curve as an asset? I think they sort of overwhelmingly voted down like freezing this wallet's capability to interact with Aave. but I think that there's probably a good chance that they'll freeze this market some point in the future. And anyways, they're trying to convince people to migrate to Aave v3, which should hopefully prevent against this kind of issue in the future. And yeah, that does it for me. I think we'll go to any questions now.
Great. Thank you so much, guys. And we can now take some time to answer questions. You can ask any lingering questions in the questions tab. Other than that, we'll go through some of the ones we included here. Also, in case you're interested, we already have the registration open for our July research call. It will be the last week of the month, hopefully right before or after you all did your vacations. And you can register. I just sent it in the chat. So going on to the questions. Let's start with, maybe we can just start with the most recent one. Will the lack of CRV liquidity on the market make the risk of his position liquidation higher? I'll let Riyad answer that.
Yeah, I would say absolutely it does. It makes it more prone to volatility. This is actually the position that Avi, the hacker that was recently arrested, was sort of targeting with his curve exploit. That he wasn't successful. But the centralized liquidity is bad. There is a good amount of liquidity in Curve itself. There's about 45 million on the Curve platform. That's total value locked. But I think, yeah, it certainly does. I mean, that's really always been the concern with these adding these assets as collateral, is that they're much more volatile. They're much less liquid than something like ETH is, for example. People will always be willing to liquidate for ETH. There's always, a huge liquid market for that. Whereas for Curve, it just doesn't compare. So yeah, short answer, yes.
Great. Okay. So next one, data is great, but also wondering if you measure beyond the market, helping exchanges and tokens understand trust, reputation, and sentiment. So that's a good question. We actually do have an exchange ranking, which specifically looks at some non-market data related metrics, such as regulation, the quality of the technology. Again, exchange rankings are always imperfect. For example, we still have Binance US and Binance ranked pretty highly on it. It's just very hard to gather all the metrics required to give a very nuanced description of a cryptocurrency exchange, but it's a good indicator for just a few isolated parameters. So you can see that on our website. Okay, so now we're going to talk about, we have a question on depegging of USDT. Does this mean USDT holders, investors still believe that Tether is backed one-to-one by its holdings? Even when additional data on Tether's holdings becomes available, the one-to-one question never seems to conclusively be resolved. That's a good question. I think it's still very hard to tell, but I'll let Riyad answer that too.
Yeah, I mean, this just seems like the enduring question that we'll never have an answer to that satisfies everybody. I don't really have a good read on, what the backing looks like. I think the sort of more what I'm referring to is the fact that the bar for redemptions is actually quite high. It's like $100,000 minimum redemption, plus you're hit with the 0.1% fee. So that really incentivizes, it really keeps supply in the market. It's a lot easier for the average person to just sell their Tether for USDC, for example, rather than go through that process and take that fee, when you could probably actually get, better execution on the centralized or decentralized exchange most of the time. So I think that is an issue, just sort of not allowing for the free flow of redemptions and supply to sort of fluctuate with demand. That could sort of lead to more frequent depegging events. So
this one's on Kraken's API, whether it's robust For trading, this is something, well, we're not traders at Kaiko, we're data providers, and we form connections with every single exchange, and they all have very similar APIs for data collection. Some, of course, are better than others, but we don't have a comment on, I guess, the specific robustness of Kraken. I would say it's up to you. You can do your own risk assessment on exchanges using all the data either that Kaiko provides, our exchange ranking, but also other information you have access to. Okay. Now we have a question on market depth. Does the drop in 1% depth reflect the amount of wash trading or people pulling out due to SEC charges, or is it hard to say? I'll let Connor answer this one.
Yeah, sure. So market depth is, it's orders essentially that haven't been filled yet sitting there in an order book. So that wouldn't really be related to wash trading, just because purely the orders have yet to be filled really. Once they're filled, that depth is gone. We've done research into wash trading before and found potential evidence of wash trading on an exchange like Bitfinex. And in that instance, it was literally a buy and a sell for the exact same amount within like a second of each other. So wash trading would be more kind of instantaneous. And then also on the 1% side of things, we take 1% for a reason. In that same kind of research that we were doing, we found that a lot of exchanges kind of try and game, I think, the 2% depth figure, because that's the figure that's listed on these exchange ranking websites. So like CoinMarketCap and CoinGecko have introduced like a column that says 2% depth. So potentially some exchanges or some market makers are trying to game that figure and make an exchange or a token or whatever appear higher in the rankings. And we noticed a big difference when we took 1% depth. That's some of those 2% depth. So let's say Bitfinex again, which was the example I found again, and that's what kind of led me down that path, was that Bitfinex had like insanely high 2% depth and were claiming to be one of the top exchanges in terms of liquidity. But when you looked at 1% depth, which wasn't listed on any kind of exchange website, that depth was completely gone and it wasn't actually real depth. So two things to that. Yeah, market depth doesn't really relate to wash trading, but also we take 1% for a reason over 2% because we think maybe perhaps some people are gaming the 2% figure. But yeah, definitely in terms of like that depth figure pulling out due to SEC charges, that's definitely happening. Like market makers don't really want to get caught in like a battle between regulators and exchanges. They don't want to be caught in the middle of that. Any kind of market makers that had funds left in FTX are bearing the brunt of that, and now we're going through a whole bankruptcy process, and they don't want to have that happen again. So whenever kind of this any kind of threat of regulatory enforcement happens, they'll pull money off exchanges and take basically a wait and see approach until they get more clarity, which is just something we don't really have at the minute in the US. So yeah.
Okay, so now we have a question on alt trading volume during Asian hours. So I think that in certain regions, for example, South Korea, there is a huge majority of all transactions are for altcoins, in which case, yes, at the exchange level, there is more altcoin trading volume on these Korean exchanges during Asian hours. However, we haven't yet looked into specifically isolating altcoin trends in volume, but that's a good idea. We might even cover it in the next newsletter, so you can subscribe, but we'll take a look at that, sort of isolating Bitcoin versus altcoin volume and the time of day that these trades are executed. However, we were specifically here looking at US exchanges, which typically are blocked off to other regions unless they have a specific license in that region. Okay, we have one last question. What about different order types like iceberg, post only, and the market depth data? I think that depends on the exchange, whether they output all of that information. I know that there's some funky market depth differences between cryptocurrency exchanges that are not always clear or recorded in the exchange's documentation. Again, this is sort of why market data in the crypto space is very complicated to collect and understand, because every exchange sort of does it a little bit differently. So that's, I guess, all the information I have on that. Okay, well, thank you all. We're right on time, and you can register for the next analyst call in July. And other than that, thank you very much for attending, and let us know if you have any additional questions.
Thanks, everyone.
Thanks. Bye.